Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Corn futures have been range-bound ahead of Wednesday's anticipated Federal Reserve interest rate hike. The market continues to sit inside of a pretty tight band over the last 4 to 5 trading days, but in particular we've noticed that the market came into resistance and then fell, then came into support, and then bounced. This sideways motion or this sideways movement that we're now seeing will probably terminate post the Fed announcement on Wednesday. And what we believe, given the nature of the oversupply that we've been seeing in the global markets, in all likelihood, corn will continue to feel pressure and head south with regards to pricing. Now, mind you, because so much of the climate and so much of the sentiment is bearish right now, there is also the possibility of the inverse actually happening in the market receiving a technical bounce in lieu of the movement down because of oversupply. So what we want to do in particular is watch the price action and allow it to communicate to us exactly what the market wants to do. Currently, corn is overbought or very close to being overbought. So a break of the support zone should lead to continued lower prices. On the flip side, if the market's able to post and make a stand above resistance and hold above 390 or so, we could very well see a price action movement that goes up to challenge 410 or 420 before moving back down again. The December contract has also been trading in a similar fashion with regards to sideways price action. You'll notice as each day has progressed, the trading range for each day has narrowed more and more. Additionally, the volume has decreased each day as well. And so we probably won't see very much of an increase in volume till after the Fed announcement, where we'll probably see a nice little spike. But also you want to take into consideration the fact that we're going into the holiday season right now. And also, now that the Argentine president has taken office, he has gone forward and lifted the taxes on the corn, wheat, and soybean markets. And many of the farmers there have actually been waiting and stockpiling supply in anticipation of being able to get better pricing for their grain. So we're expecting a glut of supply to potentially come into the markets on a global scale. January beans currently sits at an important juncture. The most recent decline that we saw has since been retraced by exactly 78.6% retracement, which is a Fibonacci number. And that area also came in at volatility-based resistance. We have since started to decline from there, and the current pattern that we're seeing is a continuation pattern that should lead to further down prices. So below 864, we would anticipate that the market would go in to touch volatility-based support near the 844 area and potentially come in near the 807 area or so. So it's going to be important to see how this market actually reacts coming out of this area, given all of the information that we've seen with regards to the fundamentals and the supply side increases that we've seen in the markets. Last week, we also showed you how the market met resistance up against our geometric shape. We speculated on how we could potentially find support near the geometric circle itself on the arc. The market came into this price threshold this week and bounced from there, but has since in overnight pricing has broken it just a bit. So it'll be interesting to see if the market is in fact able to hold and bounce from there, or if it continues to find weakness out of this continuation pattern that we mentioned earlier. Once again, the holidays are upon us. first notice date for the January contract is only about 2 weeks away. It would only be fitting to look at the November contract as well. A few key items we'd like to bring to your attention with regards to the November soybean contract. First of all, the highlighted box is showing us or highlighting for us a potential Gartley pattern that has arisen in this contract. Here we find that the market came into resistance after retracing about 62% of the actual full range of the movement here. After finding resistance here, the market has since declined, and we spoke about a potential continuation pattern that is setting up inside of this movement here, similar to that of the January contract. Depending on how soybean decides to break out of here is going to be very important. Also of note, unlike the other contract, we made a higher low here. So we have a few key thresholds that we want to bring to your attention. Number one, if this contract is able to break the 859.25 level prior to getting above 944.5, then we're looking for severely lower prices. On the flip side, if this contract is able to break 944.5 prior to breaking 859.25, then we're looking for prices to get up to about 970 at a minimum and even challenge the 985 previous prices. So we want to have these two key thresholds on your radar with regards to what soybean is looking to do in the near term over the next couple months. As mentioned before, we have the potential rate hike on the part of the Federal Reserve on Wednesday. That too is going to potentially have great influence on the markets with regards to currency trading with the US dollar against other currencies. Any surprises on the part of the Fed could lead to currency volatility, which in turn could lead to volatility in the commodity space as well. So we want to keep an eye out for the Wednesday announcement with regards to how it may affect the commodity markets as well as currency markets. July wheat has been surprisingly strong, and it appears to be on the heels of lots of short covering on the parts of speculative fund managers. As we look at the chart here, we'll notice our geometric shape is potentially making for some resistance up against current prices. A couple things that we want to bring to your attention. Number one, after this decline that we see in this market here, it has made a 38% retracement of that decline, which coincides with the 50% retracement of the smaller decline here. That makes for a bit of confluence of price levels, which also happens to land right on top of one of our geometric shaped potential resistance support levels. So depending on how wheat responds to this area here, now that it's overbought, if we find weakness or if the prices are able to break the lows from 2 or 3 days ago, we would be inclined to believe that the prices are going to go back and retest the 470 area or so on the way back down. If we're able to stay above this zone and find some strength, then we would be looking for the prices to come up to about 523.5 before finding some reasonable amount of resistance. So current prices or current price levels right now are going to be key as we watch for what wheat looks to do in the near term. We'll close out today's session with a look at the February live cattle contract. Last week we mentioned that the 122.85 area would pose potential support, and it appears to be what's happening here. Although the market continues to be severely weak, in fact, the momentum has continued to point lower. So where we had market divergence a few days ago, or a couple weeks ago rather, inside of the market here, the momentum has continued to push lower, although we are sitting right on top of our geometric shape. So over the next couple of days, we'll continue to see what happens here. In all likelihood, we'll probably see continued weakness, but in the short term, the 122.85 area looks to be making for some potential or for some short-term support at the very least. Once this market's actually able to recover, or if for some reason it's able to hold up against our geometric shape, we could see it trace back up. But for now, the key threshold that we're looking for the next potential turns in the market would be near the January 1st timeline. And if the market continues to trade down through this timeline, then we would not be looking for a potential low to come in until mid to late January. Thank you so much for joining us for our weekly market update with Woodall Risk Management. We look forward to talking with you again in our next session.